Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China International Marine Containers Group Co. Limited Annual Report. China International Marine Containers Group Co. Limited offers a diverse range of businesses and services across various industries. The company's primary segments include: the company manufactures and sells logistics equipment such as containers, semi-trailers, and special-purpose vehicles for airport ground handling. It also provides maintenance and reconstruction services for its platforms. In addition to logistics equipment, the company designs and constructs offshore engineering equipment like semi-submersible drilling and jack-up drilling platforms. It offers finance lease, operating lease, and other finance solutions for customers in various fields. The company's services extend to airport facilities and logistics equipment, including seaport passenger boarding bridges, automated warehouse logistics systems, automatic parking system, and other airport facilities. It also provides fire safety and rescue equipment, reusable transport packaging design and leasing services, and multimodal transport logistics solutions. Furthermore, the company engages in industry city development and offers finance and asset management services. Its business scope is extensive, covering various industries such as offshore engineering, road transportation vehicle, energy, chemical, and food equipment. China International Marine Containers Group Co. Limited market capitalization of $56 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that China International Marine Containers Group Co. Limited holds a significant advantage in their industry. China International Marine Containers Group Co. Limited trades at a higher price-to-earnings ratio of 522 times and a higher price-to-book ratio of 1.03 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 60% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for CIMC Group can be identified through a thorough analysis of its business segments. On the growth side, the container manufacturing business, airport facilities and logistics segment, and offshore engineering equipment services management load segment have all contributed significantly to revenue increases in 2025. Additionally, sales to key customers such as Zind Rental and Sinitrans container lines have also seen substantial growth. On the decline side, the road transport vehicle business, energy, chemical and liquid food equipment business, and ocean engineering business have all experienced significant revenue decreases in 2024. Furthermore, sales to certain customers like SIPG and Sinitrans and CSC have also declined. Geographically, while China has seen a minor decrease in revenue, Asia, except for China, America and Europe have all experienced declines or increases in revenue. It is worth noting that these trends may be influenced by various factors such as market conditions, customer demand, and competition. However, the data suggests that CIMC Group's revenue growth and decline are largely driven by its business segment performance and geographic presence. The net income and profit margins of the company underwent significant changes over the period under review. Initially, the net income decreased by a substantial 53.97% from RMB 4,088 million to RMB 1,882 million due to various factors such as intensified competitiveness and exchange rate impact. However, in another instance, the net income increased from a loss of RMB 129 million to a net profit of RMB 8.43 million, indicating an improvement in financial performance. Profit margins also experienced fluctuations during this period. On one hand, they decreased due to factors like non-operating expenses and asset impairment losses. However, on the other hand, cost reduction and efficiency enhancement initiatives led to significant improvements in profit margins. Additionally, certain business segments such as global semi-trailer, domestic market, and overseas market, Global South, witnessed increases in profit margins by 3.3% year-on-year. The introduction of strategic investors in CIMC Wetrans resulted in a decrease in profit margin from 62.7% to 45.04%. Overall, the changes in net income and profit margins were influenced by various factors including market conditions, operational efficiency, and external events. The company's financial performance has shown a significant improvement in recent years. One of the key indicators of this growth is its ability to generate positive operating cash flow. This means that the company is able to produce more cash from its core operations than it spends on various expenses, resulting in a net inflow of funds. According to the provided references, the company's financial statements confirm this trend. The operating cash flow has been consistently positive across various periods, indicating a strong and stable financial position. This achievement is a testament to the company's efficient management and effective operational strategies. The company's debt level has undergone significant changes over the past year. According to the extracted summaries, total liabilities decreased by 6.31% from RM 106,732.434 million in 2024 to RM B 99,984.655 million in 2025. Additionally, debentures and total debt have also seen a substantial decrease, from RMB 34,079,283 to RMB 27,775,136, and from RM 212,159 million to RMB 563,893 million, respectively. However, the interest expenses have shown mixed changes. While interest expenses of borrowings decreased by 21% year-over-year, there are instances where interest expenses increased. For instance, interest in the current year increased from RM 317,762 to RM 597,202. This inconsistency suggests that while the company's debt level has decreased significantly, its interest expenses have not followed a uniform trend. The performance of various segments and regions within the company has been mixed. On a positive note, several areas have shown significant growth and success. The container manufacturing business, satellite businesses, road transportation vehicle business, energy, chemical and liquid food equipment business, logistics equipment, China, Shenzhen, CIMC Finance Company, intelligent manufacturing, digital transformation, R&D mechanism, innovation capabilities, strategic acquisitions, and Little Giant Enterprises have all performed well. These segments have achieved notable success in combating industry competition, consolidating leading positions, and experiencing a surge in orders and profits. The company's efforts in digital transformation, innovation capabilities, and strategic acquisitions have also paid off, contributing to its overall growth. On the other hand, some areas have struggled with poor performance. The road transportation vehicle business has faced intense competition, while the liquid food segment has maintained a steady pace but faces challenges in a complex environment. Energy equipment and services has also underperformed, as have certain regions such as road, chemical and fire safety, liquid food vehicles, and recycled items unallocated. Overall, the company's performance is characterized by both successes and setbacks across various segments and regions. Management is confident in the company's future prospects, as evident from their decision to repurchase shares worth RMB 913 million. They aim to continue rewarding shareholders with a stable dividend policy while focusing on strengthening foundations, pursuing innovation, and enhancing quality and efficiency. The company has identified two core tracks for growth: commodity logistics supply chain and energy supply chain. Management aims to become a high-quality and respected world-class enterprise within the next 5 years by implementing various strategies across different segments. These include leveraging global leadership in turnkey projects, expanding into emerging markets, and focusing on intelligent manufacturing. Management is also prioritizing cost management and risk control, navigating the cost-risk trade-off, and executing derivative hedging transactions to protect operating profits. They are taking a prudent attitude towards investments, allocating RMB 3.45 billion for equity acquisition and fixed assets in 2026. Furthermore, management is committed to sustainable development and social responsibility, with a vision of becoming a high-quality and respected world-class enterprise. They are enhancing corporate governance standards, strengthening risk control work, and refining the company's operations framework. Overall, management's outlook and strategy focus on growth, innovation, and sustainability, with a long-term perspective on investments and a commitment to maximizing shareholder value. The company's financial performance is marked by a commitment to rewarding its shareholders. One key aspect of this commitment is the payment of dividends. In 2025, the company paid out RMB 0.179 per share in cash dividends, totaling RMB 939 million. This payout demonstrates the company's ability to generate significant profits and distribute them among its shareholders. In addition to dividend payments, the company has also engaged in share buybacks. In 2025, it repurchased a substantial number of shares, deducting 146,179,540 from its existing total share capital of 5,392,520,385 shares. This move not only reduced the outstanding share count, but also provided an opportunity for the company to purchase back undervalued shares and potentially boost shareholder value. The combination of dividend payments and share buybacks highlights the company's focus on creating value for its shareholders. By distributing profits through dividends and reducing the number of outstanding shares, the company is able to enhance its financial performance and provide a more stable return on investment for its shareholders. Concerns about inventory buildup or supply chain disruption are evident in various sections of the report. On page 28, a decrease in production and sales volume of container manufacturing business is noted, along with a significant drop in accumulated sales volume of dry containers by 35.2%. This suggests that there may be issues with demand and supply balance. Furthermore, on pages 29 and 42, high industry inventory levels in North America and a structural supply imbalance due to growing capacity versus demand are highlighted. These factors can lead to pressure on operating performance and potential disruptions in the supply chain. Additionally, page 32 mentions supply chain disruption caused by tariff disputes and geopolitical conflicts, which can exacerbate existing issues. The report also notes concerns about inventory buildup or supply chain disruption in several subsidiaries, including Ningbo Balan Donghua Container Service Co., Limited, and Qingdao Senkit Intelligent Instrument Co., Limited. However, it's worth noting that some pages mention potential concerns, but do not provide conclusive evidence of inventory buildup or supply chain disruptions. Nevertheless, the overall trend suggests that there are valid reasons to be concerned about these issues in the industry. And that concludes the financial summary for China International Marine Containers Group Co., Limited. Feel free to comment below, and I will be happy to answer them when possible.